The Lyft IPO raised billions, but can the ride hailing company drive long term growth for investors? Plus, if you change jobs, there may be lost money you need to find when retirement arrives, or maybe get on that now. We'll fill you in on what's going on and what you can do about it. Those two headlines, plus the big idea tying them all together, and much more on today's Money in the Morning. Welcome to Money in the Morning. I'm Bobby Rebell from the Financial Grown Up Podcast, coming to you from my very grown up kitchen in New York City. And my partner, Saul-Sehy, cannot be with us today. I will talk more about the Lyft IPO soon, but he is cashing in his shares, I think, while we speak. For the rest of us, this is the podcast where we cover two recent stories ripped from the financial press. We don't just read them like those other podcasts, just saying. We get into why they matter to you and what you can do to take action to make sure you get the best deal and have the best financial freedom outlook for you. We're also going to wrap it all up with a big idea at the end of today's show that you can take with you and make your own. Money in the Morning is brought to you by Tiller. Manage your money 10 times faster in a spreadsheet with Tiller, the only service that connects your banks to Google Sheets and Excel with your daily spending, transactions, and balances. Go to stackingbenjamins.com/Tiller for more info. All right, good morning, everyone. We have a lot to talk about. Some very interesting things happening in the initial public offering market. So many big names that we've been hearing about coming to market. And we are going to talk about Lyft, which went public on Friday at $72 a share. That was the initial offering price, and it was way above the very first range that they thought. It was at the top end of the final pricing range, and that basically indicates there was very heavy demand. So I wanted to be talking about that with you guys. So let's get to the headlines. Kick it off, Laura.
Here are today's Money in the Morning headlines. Ready, set, go.
All right, my friends, headline number one, with Lyft offering, the IPO casino is now open. And this is a story from MarketWatch, drawing a blank there. And the author, it is an opinion piece, I do want to say, I want to make that clear, is Teresa Poletti. And as I said, the headline is, with the Lyft offering, the IPO casino is now open. Again, it is an opinion piece. The big demand for shares of Lyft, one of the most anticipated IPOs of the tech unicorns, is the unofficial opening of this year's IPO casino. It goes on to talk about the fact that it priced at the higher end of its range, as I mentioned, and that it is coming to market ahead of its better funded rival, Uber Technologies, and says that it's an impressive feat and it's going to lead the way for a string of long-awaited IPOs of tech unicorns, so-called because of their private valuations of at least $1 billion. So we hear the term unicorn tossed around a lot. That is specifically what they're saying. These are private companies that have raised money. They're generally very mature companies, and they've been very successful raising money in the private market. And because of that, there's been a lot of anticipation for when the public can actually get involved in some of these IPOs. But as you're going to hear, it's a little complicated. All right, the pricing also shows that many IPO investors don't care very much about long-term investing, and those buying up initial shares of Lyft and likely other tech unicorns are more interested in getting in on a much hyped deal than getting out and then getting out quickly. Quote, this is from Kurt Schacht, Managing Director of Standards and Advocacy at the CFA Institute. He says, quote, I think the IPO world has just changed in the last few years. There was always an opportunity to get an allocation and the notion of the first day pop. But what the issuer crowd has figured out is that many people are lined up for these deals. It's more like a casino than an actual investment. That's because Lyft, like several recent tech IPOs and surely more to come, has a corporate structure that keeps its founders entrenched with the bulk of voting control, a popular concept in Silicon Valley, which loves to keep its founders in charge even when things go badly. Lyft, like many tech companies of the current vogue, has issued dual class shares. Class A common stock to the public with 1 vote per share, Class B stock with 20 votes per share to its founders. According to Lyft Prospectus, co-founder and chief executive Logan Green and co-founder and president and vice chairman John Zimmer together own a 49% voting stake with their ownership of Class B shares. That combined with the shares of 12 other Lyft executives and directors will give the company insiders 60% voting control upon completion of the IPO. And it says in its filing, and this is in the SEC filing, everyone, quote, our co-founders, individually or together, will be able to significantly influence matters submitted to our stockholders for approval. Our co-founders, individually or together, may have interests that differ from yours and may vote in a way with which you disagree and which may be adverse to your interests. In other words, they have the power, and it's not one share, one vote for them. They get 20 times your voting power, and they can just go ahead and do what they want. This is something, and I think the article is going to go on to talk about it, that we see with other companies like Facebook and Snap. So I'm going to go on with the story. Lyft has made a token effort to improve its corporate governance by naming Sean Agarwal as its non-executive chairman in January. He's the CEO of Sort Capital, an early-stage VC firm. Granted, Lyft's founders, this is just going to put it in perspective, everyone. Lyft's founders do not appear to be as omnipotent, I'm terrible at pronouncing that word, as Mark Zuckerberg is at Facebook, where the co-founder and CEO still controls about 60% of the votes. Or, this is where it gets really crazy, Snap, which is another well-known IPO that did not do well in the end, where co-founder Evan Spiegel and other executives control, get this everyone, 96.4% of the vote. And this is what happens when a company has so much control of the vote. The article goes on to say, the developer of the Snapchat app, that's Snap, held a 3-minute annual meeting for shareholders. So, because why bother, right? Because they have all of the control. So even if you buy shares of Snap, you really don't have any control. Now, you may benefit if they make good decisions and it's good for the stock. It's not that you don't have legit stock. You do. But in terms of the actual decision-making power, especially when these companies become controversial, as certainly Facebook has, there's not a lot of ways for the shareholders to make changes in management when management controls everything. So that is something really important that people should be aware of when they buy into these offerings, the dual class share. Let's talk a little bit more about Lyft. I did bring some fun facts for everybody. In addition to the fact that not so fun that the insiders will have 60% voting share, a note from CNN. As a token of goodwill to the drivers, Lyft granted cash bonuses to drivers who meet certain ride thresholds, $1,000 for 10,000 trips and $10,000 for 20,000 trips ahead of the IPO, so they could, in theory, I don't think they have to, but they could opt to put it towards stock. So I thought that was kind of a nice thing that they did for their employees. And then online real estate firm Redfin estimates that the shares and the stock options held by Lyft employees are now worth $1.3 billion, which is a good thing because you know what? Housing out in Silicon Valley is apparently very expensive. And one more final fun fact here from the Wall Street Journal, 9 US-based startups have been valued at more than $10 billion by private investors, and about half of those are expected to go public. So we're going to be seeing a lot of other big deals. And I also want to mention a few other big deals to be watching for in this, I guess it's kind of IPO season here, is Pinterest, which, by the way, is also going to have a dual share structure. So just be aware of that if it's an IPO that you're interested in buying shares of, that you do have that dual structure, and you should be aware of the implications of that. Other names to look for include Slack, Uber, Airbnb, and Palantir. And I just want to take at least one comment. For those of you listening to the audio podcast, we do film this in front of a live Facebook audience. You can join us at facebook.com/iStackBenjamins. And we have a comment from Dylan pointing out that the IPO, meaning Lyft, hasn't hit a profit yet and a net loss of over $900 million last year. That's another thing. It's a great point that Dylan makes because many of these companies, you can go public, you can even be a relatively mature company and have high valuations and lots of investors, but that doesn't necessarily mean that you are profitable. And so it's important that investors understand what they're buying in. That said, some very successful companies like Amazon took a very long time to go public, to turn a profit. And so that's not necessarily an indicator of whether the company will ultimately be successful, but it is just something that you should be aware of. And Kathy is just chiming in. Why is it called a tech company? Well, because it's basically an app. So that's why it's considered a tech company, because it runs on an app and the whole system is through technology, the way that it connects the drivers with the passengers and with the company. So it all comes together through the app. And that's why it's considered a technology company, because without that system, we really could not have companies like Lyft and Uber. And let me just take one more comment from Sandy. And Sandy says Pinterest she would buy because it is at least profitable. So we'll keep an eye on Pinterest and maybe we'll talk about that here on this show. Finally, I just want to get to our takeaway from this, and that is, who's the boss? It's important when you're buying anything that you understand who is in charge. That comes to not only stocks, but maybe if you're buying real estate, let's say in a community, you want to know whether it's for example, a co-op in New York City or a community that has community dues, who's in charge, who's on the board. Sometimes it's not a board, sometimes it's one owner. Make sure you understand what you're buying into and what kind of control you're going to have in that investment, because it's not always what you expect it to be. Let's move on to the second headline. This hits home, I think, for pretty much every person on the planet that wants to ever retire. So the second headline is, if you change jobs, there may be retirement money. I like that. I like the idea. It's almost like a mini lottery. I don't know if anyone entered the big Powerball last week. I didn't win. Hope you did. Let me know if you did. This story comes to us via USA Today, but it's actually an Associated Press story from Sarah Skidmore Sell. And it starts, no one wants to lose money, particularly for retirement, but it happens. People lose track of or don't know they have retirement accounts. It's surprisingly easy to do. People switch jobs, move, change names, and the company or the plan provider loses track of them. Or an employee can't keep track after a company is sold or a plan is terminated. Some people don't even know they were eligible for a pension, didn't realize they were vested, or were unaware they were automatically enrolled in a 401k. While an employer should inform employees of their options when leaving, employees sometimes forget to complete the paperwork, said Thomas Nee, co-founder of Compass Point Retirement Planning. There's also little requirement or incentive for companies or plan providers to find beneficiaries. There's no exact measure of how many unclaimed benefits are out there, but a report released last year by the Government Accountability Office states that between 2004 and 2013, more than 25 people left at least one retirement plan behind when they left a job. Let me just say that again. 25 million people left at least one retirement plan behind when they left a job. Oh my gosh, like it's not hard enough to save for retirement. Keep what you're actually saving, my friends. All right, so then the article goes on to give some tips on what you can do if you think that you might be in this camp. All right, number one, check your paperwork. If you have paperwork on an old pension, 401k, or other retirement plan, this is a good place to start. Contact the company that manages the plan and go from there. So it's important to note, they say the company that manages the plan. That may not be the company that you worked for. It may be a different company that is in charge of actually managing that. So they may outsource that to, for example, a brokerage firm or a money manager that's actually the person, the entity that has the money and is managing it. In some cases, you may want to grab old taxes, W-2s, or other employment-related documents while you're digging through the paperwork. This documentation can help if the process proves difficult. In some cases, the hunt to find and claim benefits can become very complex and take years, particularly if a company has been sold more than once over the years, says Karen Ferguson, director of the Pension Rights Center. It's probably a really good organization to check out, the Pension Rights Center. All right, second piece of advice, contact your old employer. The next step should be contacting your old employer to request information about what retirement benefits you're due. If you cannot find them, search the Department of Labor's website of Form 5500 filings to find out if they are still in business. This form should have contact information for the plan. Number 3, get help on lost benefits. There are a bevy of databases and organizations that can help you find benefits and provide direction. The Department of Labor's Employee Benefit Security Administration, EBSA for short, everyone, EBSA if you want to look it up, provides help over the phone and online, including a searchable database for abandoned plans, www.askebsa.dol.gov. The Pension Benefit Guaranty Corp is a federal agency in charge of insuring private sector pensions. If the plan is in trouble, this is important, the PBGC steps in and they say there are more than 80,000 people who earned a pension who haven't claimed it yet. Those unclaimed benefits total, you ready for this? It's kind of like if you won the lottery, if it was everybody, $400 million with individual benefits ranging from 12 cents to almost $1 million. Can you imagine if you were the guy that had $1 million in pension benefits and you kind of forgot about it and you left it, and then maybe you're listening to this and you decided to try to find it and you actually found it. Be in touch with us if that happens to you. The state's unclaimed property. In some cases, the money is handed over to a state's unclaimed property division. Each state maintains its own database, but the website missingmoney.com, created by the National Association of Unclaimed Property Administrators, can also provide information about each state's programs. And then, of course, the Social Security Administration will provide a notice alerting you to potential benefits when you are ready to claim Social Security, but the notice does not guarantee those funds will still be there. One more place to go. The U.S. Administration on Aging's Pension Counseling and Information Program provides free, we love free legal assistance to those experiencing a problem with their pension, profit sharing, or retirement savings plan. It currently serves 30 states. If your state isn't covered, check out pensionhelp.org, a website of nonprofit pension rights centers. It helps connect people with counseling projects, government agencies, and legal service providers that offer free information and assistance. So this is saying to me that this is definitely a project, but it could be a very profitable project because for all you know, you could be that person with $1 million, and it's certainly worth the effort. But you know what? Even if it's a lot less than that, it's your money. And I think it's important to figure out how to get your money back. Finally, the article finishes with small balances. And many people that have left jobs experience this, that if you have a 401k that has less than $5,000 in it, federal law allows those balances to be moved to an IRA without the beneficiary's consent. These can be hard to find, but try the EBSA's Abandoned Plan Search, the state's unclaimed property site, or contact the company that used to manage those benefits to find out where they have been sent. So certainly I would do my homework for those kind of numbers. I think it's really important. And I know when I have left jobs, they do encourage you to take the money with you because ultimately they don't really want to have a ton of old employees' financial assets on their books. That's really not the business that they're in. It is interesting, though, and it should be noted that when you move money from a 401k, as they're alluding to in many cases, into something like an IRA, it's important to know the rules, to do it within the 60 days, make sure you don't end up paying tax accidentally, and then also to understand that the protections do change, that there are certain protections afforded to 401ks that don't necessarily translate to IRAs. So read up on those. Maybe we'll do a separate episode on that at another point, but just understand that things do change a lot. And to be on top of it, when you're changing the job, hopefully not all the way when you're retired and you kind of think, maybe I did have a pension at that old employer and I forgot to actually ever transfer it. It's better in terms of keeping track of it to just take it with you right away. I've consolidated all of my retirement accounts from all of my employers, and it's nice. And you see a bigger number, which will make you happy. So let's go to a couple comments quickly before we do the takeaway from that story. And we have Kathy here, and she says, trying to get the money from the state's unclaimed property is a nightmare. Too many hoops to jump through. Tried getting a couple hundred back when my stepmom passed away, and we finally gave up. That's terrible. Well, hopefully with technology and improvements in systems, that will improve at some point, but it's really a shame because that's your money. And I hope it's still sitting there, and maybe there's a better way for you to get that money. But yeah, that just stinks, Kathy. I'm sorry to hear that. And we have a good comment here from Sandy, and she says, I forgot about pension at my old employer all the time. I remember when they send, did I miss the beginning of this? I remember when they send me mail every year trying to get me to cash it in. Right. I'm going to remember to write this down on my list of assets. Right. So you at least, Sandy knows that the money is there. And if it's there and you know it's there and they're still sending you email and you're getting it, they know where you live, you can get it. You'll get it eventually. So it's okay. But wouldn't it be easier if you just check that off your to-do list along with Sandy, put it all in one consolidated place, and then you could also maybe have a little more buying power at whatever brokerage firm or investment company you work with, because you would have a larger balance, and maybe you can get, for example, lower fees there because you would have all of your assets in one place. So I think that's a good thing to be focused on. So let's now move to the takeaway for this, and that is get thee to the lost and found. Find your money, take control of your situation, and keep your money. It's your money. Don't be dependent on somebody else keeping track of it. You never know what's going to happen. You don't know if a company goes out of business, if they merge, whatever obstacles there are now, as Sandy put so, Kathy put so clearly. I'm not speaking clearly, but she did in her comments. They're only probably going to get worse if it's with a company, because the company gets further and further away from you. They could be bought, they could buy other companies, they could rebrand, they could go out of business. It happens. Look, WOW Airlines in Iceland went out of business, and all these people lost their ticket money, but who knows what happened to the employees? And I don't know anything about Iceland law and what protections they have, but who knows? So if you've left a company, go get your money, get to the lost and found right now, and consolidate that. So thank you to everyone for your great comments on that story. Before we get to the big idea, we are going to just talk about Tiller, because Tiller is something that is very appropriate for this conversation, because it helps you get organized. Because Tiller it's the only service. It connects your banks to Google Sheets or Excel with your daily spending, transactions, and balances. It helps you manage your money. It helps you know what's there. It helps you see the big picture. And basically, you can make better decisions and hopefully have bigger account balances if you see a clear picture. And the best way to do that is to be organized. And again, if you're organized, you hopefully have a lower chance of just oopsies forgetting your retirement money along the way as you live your life and go through different jobs and different employment situations. Keep your money tight. All right, let's get to the big idea. And what we want to talk about is being in charge. We talked about knowing who the boss is. We talked about going to the lost and found. But at the end of the day, the big idea is that you have to drive yourself. You need to be in the driver's seat. You cannot let anyone else decide what your financial future is. And that applies, first of all, in the IPO market, in any stock that you buy, frankly. Even if you're buying, say, Facebook, you need to be okay with the fact that Mark Zuckerberg has a lot of control over that company. If you're going to buy into Snap, you need to know that the founders and the insiders have almost 100, they have 96% control. You are not in charge. You're just along for the ride. The ride could be great. You could make a ton of money at any of these companies. Who knows? But you're not in the driver's seat at all. The same thing with leaving your money, a little money trail as you go through life and go through different jobs. If you let other people constantly be in control of your money, you're not the boss. You're not driving, you're not in charge. So drive yourself, get that money, sweep it all up along the road, put it in one safe account so that you know what you have and you are making proactive decisions, whatever they may be, about how you want to invest it and how you want to allocate your resources. And I think that's a way that you will live a richer life. So thank you all for being part of this show. We had a wonderful Facebook audience with us here at Money in the Morning. If you guys want to join us at Money in the Morning, go to facebook.com/iStackBenjamins, and you can be part of the audience, and hopefully we can get your comments in on the show as well. On behalf of my partner, Joe Saul-Sehy, who will join us for a show very shortly. He's, like I said, he's busy cashing in his Lyft stock, probably trying to get in on that Uber IPO as well. I'm Bobby Rebell, and if you want to live a rich life, be a financial grown-up. Bye, guys.
This show is created by Joe Saul-Sehy, hosted and produced by Bobby Rebell and Joe Saul-Sehy, is engineered by Caden Thompson, and all put together by a pack of well-trained ferrets down here in Joe's mom's basement. You'll find Bobby at the Financial Grown-Up Podcast and Joe at the Stacking Benjamin Show. Go say hi to them there, too. Online, visit us on Twitter at Average Joe Money and at Bobby Rebell, or come join a live recording at our Facebook page. That's facebook.com/iStackBenjamins. I know you already know this too, but Money in the Morning is for entertainment purposes only. You should not act on anything recommended by a bunch of entertainers in a basement or even a Manhattan kitchen without first consulting your financial advisor. And second, dude, have your head examined. Have headlines you'd like us to discuss? Send them to joe@stackingbenjamins.com or put them on our Stacking Benjamins closed Facebook group. This show is a collaboration of Stacking Benjamins LLC and BRK Media LLC. Copyright 2019. All rights reserved. I'm Joe's mom's neighbor Doug, and I reserve the right to always say, we'll see you next time back here on Money in the Morning.